let's talk about profitable growth, and in particular, the rule of 40. Now, a lot of you may be familiar with the rule of 40. It's actually come up because recently Palantir was talking about it in their quarterly report, and that's a metric that they use. But what is the rule of 40, first of all? So annual growth plus profit margin, so both in percentages. So let's say your annual growth is 20%, plus your profit margin, typically pre-tax margin is what's used. Let's say that that's 10%. Well, then you'd come up with a rule of 40 number of 30. And the rule of 40 dictates that for a growing startup that's on its road to success, that you want to be at or above 40% when you combine those two metrics. So that's what we see here. But what's interesting is VCs actually look at it in a particular sort of way. You might think that like, oh, okay, rule of 40. So you want me to be at 20% growth and 20% profit margin, right? And that gets me to 40. And that's good, right? But actually, they are far more obsessed with growth than with profit. So you may have heard of a concept called 3T2D. What that means is triple, triple, triple. So 3 triples in a row, followed by double, double, 2 doubles in a row in terms of growth rate. So that would mean 200% growth, 200% growth, 200% growth, and then 2 years of 100% growth. So astronomical growth rates, that's historically what was looked at, and this is before the AI era, as what it took to get to 100 million in revenue, starting from a very low base. And you do the math. Well, if you triple, that's 3x, and then you triple again, that's 9. You triple again, that's 27. And then you double that, 54, and then you double again, that's over 100. So it's basically taking you from, 800,000 in revenue or $1 million in revenue to over 100 million in a relatively short time frame. Now, in the AI era, you might say that the stakes have risen even further because you've got companies like Cursor and Windsurf that are, Lovable, Replete. All of these companies are blowing the doors off of growth rates and setting new records to 10 million in revenue, setting new records to 100 million in revenue. So these timeframes are compressing and compressing. But the dirty little secret is that many of them are insanely unprofitable. And when you're that unprofitable, you're essentially playing lottery. Because if you get lucky and you get bought, okay, great. And if you don't, and if you don't get that next round of gigantic funding, if the funding market or if there's an AI plateau, we're starting to see a little bit of evidence of that with GPT-5. But if that happens, well, then what happens to your company? It goes poof because you are burning money at such an astronomical rate. So even before the AI era, we can look at what was the VC version of a successful rule of 40. And so taking into account that kind of tripling and doubling kind of concept, it was like this. So 100% growth plus, or you could say minus, so plus negative 60% profit margins. That would have been an acceptable, and actually that remains today, that is an acceptable approach for many VC-funded businesses, or that's how they look at the world. They want to spend everything on growth, even if you're literally just burning money. They view it as their job to just put on more coal in that fire, just keep on going at astronomical rates. And, of course, the risk is that if your growth rate turns, that doesn't work out, and you're running a negative 60% profit margin, well, the story ends very quickly because you just burn out of your capital. So when we look at it from a more practical perspective, certainly from a bootstrapper's perspective, that would be my perspective. But even if you're just trying to run just a bit more prudently, then you want a little bit more balance. And if we look at, okay, what would the profitable approach be? All right, so that's one version of how to get to a rule of 40, 30% growth with 10% profit. You might rebalance even more, but one thing to keep in mind is that you do want to have, there is sort of a lower floor. There's a floor to where growth rates need to be. If your growth rate isn't at least 20%, then you're kind of getting into slow growth territory. 20% would sort of be the lower bound red line, because the rates of return upon which all, not just VC models, but private equity, acquirers, everyone, they're always looking for an internal rate of return of 20% or more. And so that means that they want to buy properties, they want to buy companies that are growing at least at 20%. Will they buy companies growing slower than that? Yes. But when they move into sub 20% mode, they're moving into value territory where the multiples are just going to be much lower. And of course, the higher you get above 20% on the growth side, that does impact valuation. Profit margins impact valuation as well, but not actually as much as the growth. So you might say, okay, 30% growth, 10% profit. That's the last thing that I would say here, is that when approaching this rule of 30 and this idea of profitable growth, you've got to be at least 20% per year on the growth side, and then profit layered onto that. A good number, from the profitable kind of approach would be, hey, still 40, 50, 60% growth, and then layer profit on from there.